Hey everyone! So, if you're an investor, you've almost certainly heard the term bonus issue and probably thought, awesome, free shares. But are they really free? Today, we're going to pull back the curtain and really get into what a bonus issue means, not just for a company, but for you and your portfolio.
So let's just start with a really direct question. Imagine a stock you own announces a one-for-one bonus issue. For every single share you have, you're getting another one. On the house, the number of shares in your account literally doubles overnight. So, does that mean your wealth just doubled? Well, the answer is not quite, and understanding why is what separates a good investor from a great one.
All right, here's how we're going to break it all down. First up, we'll solve that free share puzzle. Then, we'll get into the accounting of it all, how the company pie is sliced. After that, we'll look at why it's such a powerful confidence signal, talk about some common investor traps you'll want to avoid, and finally, wrap it all up to make you a smarter, wiser investor.
Okay, let's get right into it. What is actually happening when a company issues bonus shares? I know, it really feels like you're getting something for nothing. But in the world of finance, there's always something going on under the hood.
So at its very core, a bonus issue is really just an accounting move. Think of it this way. The company takes all the profits it's saved up over the years, what accountants call reserves, and it just converts them into new shares for you, the shareholder. The most important thing to get here is that no new money is coming into the company. It's simply moving value from one pocket to another.
You know, the absolute best analogy for this is a pizza. The company's total value, that's the entire pizza. A bonus issue doesn't make the pizza any bigger. All it does is cut it into more slices. So if you owned one big slice before, now you own two smaller slices. Your total ownership of that pizza, it hasn't changed one. So how does this whole reslicing of the pie actually look on the company's books? All right, let's put on our accountant hats for a minute. This is where we see the hard financial reality behind that idea of a free share.
Now here's where it gets really interesting. Not every country's accounting system looks at this the same way. In India, under Indian GAAP, the rule is pretty straightforward. All bonus issues are recorded at the share's face value, a nominal amount. But in the US, things get a bit more nuanced. They actually make a big distinction based on the size of the issue.
Just take a look at this. In the US, a small bonus issue or stock dividend is recorded at its full market price. Why? Because the accountants believe investors see it as a real distribution of value. But a large one, that's treated just like a stock split, recorded at a tiny nominal value. The big takeaway here is that the accounting rules are actually trying to reflect what they think investors are feeling about the transaction. Pretty cool, right?
So, if a bonus issue doesn't actually create any new value, why on earth do companies even bother? This is where we shift from pure accounting into strategy. A bonus issue can be one of the most powerful, unspoken signals a management team can send to the market.
So why do it? Well, for one, it can make a really expensive stock look more affordable and accessible to retail investors. It also rewards shareholders without the company having to spend its precious cash, which it might need for big growth projects. But the number one reason? It's all about the signal. It is management's way of standing up and saying our past success is rock solid and we are incredibly confident about our future.
And this, right here, is the crucial point. When a company moves money from its reserves into its share capital, that is a one-way street. That money is now permanently locked in. It can never be paid out as a simple cash dividend down the road. It's a very real, very costly commitment. And that is precisely why the market pays so much attention.
Okay, let's switch gears and talk about what all this means for you, the individual investor. Because even though the shares feel free, they come with some really important tax implications and can lead to some clever but risky tactics if you're not paying attention.
Here's a number that trips up so many investors. 0. For tax purposes, the purchase price, or what's called the cost of acquisition, for your bonus shares is 0. What does that mean? It means when you eventually decide to sell them, the entire sale amount is considered a capital gain. Now that's not a problem, but it's something you absolutely have to know for your tax plan.
So this zero-cost rule leads some people to try a tactic known as bonus stripping. Here's the idea. You buy a stock right before the bonus is issued, you get the free shares, and then you immediately sell your original shares at the new, lower price to create a quick loss on paper. You could then try to use that artificial loss to cancel out other real gains you might have. But the tax authorities are way ahead of you on this one. Section 94-8 of the Income Tax Act was written specifically to shut this down. If you try a trade that fits this exact pattern, the law simply says, nope, that loss doesn't count.
Instead, the amount of that disallowed loss gets added to the purchase cost of your bonus shares, which completely neutralizes the whole tactic.
All right, so we've covered the theory, the accounting, the strategy, and the taxes. Let's wrap this all up by looking at how these concepts come together in the real world to create just immense long-term wealth.
And honestly, there's probably no better example of this in the Indian market than Reliance Industries. They have a legendary history of using bonus issues to reward their most patient long-term shareholders. I mean, just look at this number. It's staggering. If you had bought 1,000 shares of Reliance way back in 1983 and just held on through all the ups and downs, today you would have 25,600 shares from bonus issues alone. And while the share price adjusts downward after each bonus, a truly great company's value just keeps growing over time. That much larger number of shares then becomes incredibly valuable. That is the beautiful magic of compounding.
Ultimately, this is what it all boils down to. A bonus issue isn't just some dry mechanical transaction, it's a story. It's a company looking at its years of saved-up profits and declaring to the world, this success we've had, it's real, it's permanent, and we're confident we can build on it.
So the next time you see a company announce a bonus issue, you're not just going to see free shares. You'll know to ask the deeper questions. Is this company doing this from a position of real strength? Are they doing it because they have better plans for their cash than just giving it to me? And most importantly, what does this signal about their confidence in the years ahead? Answering those questions, well, that's what being a truly great investor is all about.